Did you know that despite rising interest rates hitting 7%, real estate can still be a smart investment? Many people are asking if now is the right time to buy, fearing that higher borrowing costs might kill their potential returns. But what if I told you that with the right strategies, you can still make profitable deals and grow your wealth even in this challenging market? This video will reveal how to navigate the current landscape, avoid costly mistakes, and find opportunities others are missing. Whether you're a seasoned investor or just starting out, understanding the real impact of 7% interest rates can change everything. So, if you're serious about making your money work for you, stay tuned. And don't forget to like and subscribe for more tips. Now, let me show you why this is so urgent and what you need to know before getting started. Today, we're exploring a question that many investors and prospective homeowners are asking. Is real estate still worth it with 7% interest rates? In this video, we'll break down what this means for your investments and your financial plans in the current U.S. economic environment. Right now, rising interest rates have made financing more expensive, leading many to wonder if buying property still makes sense or if it's better to wait. This is especially relevant for those who are new to real estate investing or considering their first purchase. By the end, you'll understand how these higher rates impact property values, rental income, and overall profitability. You'll also discover strategies to navigate this market wisely, avoid common pitfalls, and identify opportunities others might overlook. Whether you're an experienced investor looking to adapt or a beginner trying to get started, this knowledge can help you make informed decisions and keep your money working for you. But to make smart decisions, you first need to understand the economic landscape we're dealing with. Despite the recent rise in interest rates to 7%, the U.S. housing market still presents opportunities for investors and buyers. According to the Federal Reserve, the federal funds rate has increased from near zero levels in 2021 to its current range, impacting borrowing costs across the economy. The rise in rates aims to curb inflation, which, as reported by the Bureau of Labor Statistics, remains elevated at around 4.5% annually, well above the Fed's 2% target. This inflationary pressure has led to higher home prices historically, but recent mortgage rate hikes have begun to slow price appreciation and even cause slight declines in some markets. Higher interest rates make financing more expensive, increasing monthly mortgage payments and reducing affordability for many potential homeowners. Meanwhile, the Consumer Price Index indicates that inflation still erodes purchasing power, influencing both rental and homeownership decisions. Tax policies and market cycles also play a role. Higher taxes on real estate transactions and shifting supply-demand dynamics can either cushion or exacerbate price fluctuations. The housing market is currently in a transition phase, moving from a record boom during the pandemic to a more balanced or cooling environment. While higher rates create headwinds, they also filter out overly aggressive speculation and can set the stage for more sustainable growth in the long term. With that context in mind, let's break down a strategy you can actually apply. Is real estate still worth it with 7% interest rates? The main idea is to understand how to navigate the market and make smart decisions despite higher borrowing costs. When interest rates rise, borrowing money to buy property becomes more expensive. This means your monthly mortgage payments increase, and it can affect how much house you can afford. However, this also creates new opportunities for investors and buyers to approach real estate differently. One key strategy is leveraging, which means using borrowed money to buy property. If done wisely, leverage can amplify your returns, especially if property values grow over time. But it also comes with risks. Higher interest means higher costs, so it's important to analyze whether the investment will generate enough income or appreciation to cover these costs and still be profitable. Another important term is cash flow, which is the money left over after expenses like mortgage payments, taxes, and maintenance. Maintaining positive cash flow is crucial, especially when interest rates are high, because it ensures your investment remains sustainable. To do this, investors often focus on properties that can generate reliable rental income, helping to offset higher mortgage costs. Additionally, savvy buyers consider the timing of their purchase, look for properties with potential for appreciation, and evaluate their own financial situation carefully. The goal is to find opportunities where the benefits outweigh the higher cost of borrowing. Now let's look at a real-world example to see exactly how this plays out in practice. Imagine buying a single-family home in Dallas for $350,000. With a 20% down payment of $70,000, you take out a mortgage of $280,000. At a current interest rate of 7%, your monthly principal and interest payment on a 30-year loan would be approximately $1,872, according to mortgagecalculator.org. Now, let's assume you rent out the property for $2,500 a month, generating a gross rental income. Deducting estimated expenses, property taxes of $4,200 annually, insurance around $1,200, and maintenance costs totaling $2,400. You're left with roughly $1,300 per month in net cash flow. This means you're covering your mortgage and still earning a positive cash flow of about $1,300 each month. Over a year, your rental income could accumulate to $30,000, while expenses total roughly $8,400, leaving about $21,600 in net income. If the property appreciates at 3% annually, its value could increase by roughly $10,500 in a year, boosting your equity. This scenario shows that even with higher interest rates, a well-chosen property with solid rental potential can generate positive cash flow and appreciation. However, it's crucial to evaluate the risks. Market fluctuations, vacancy rates, and unexpected expenses that could impact these returns. This looks great, but only if you avoid the common traps that ruin deals like this. Investing in real estate with a 7% interest rate can still be a smart move, but there are common pitfalls that could derail your success. First, many investors overlook the importance of maintaining good credit. A poor credit score can lead to higher interest rates or loan denials, making your investment less profitable. For example, a friend of mine once skipped checking his credit report and ended up with a loan at a much higher rate than expected, cutting into his returns. Second, overpaying for a property is a frequent mistake. Without thorough market research and proper valuation, you might buy above market value, reducing your potential profit. I saw someone pay full asking price during a hot market, only to see property values stagnate later, affecting their long-term gains. Third, skipping due diligence on the property itself can be costly. Failing to conduct inspections, assess potential repairs, or analyze local rental demand can lead to unexpected expenses or vacancy issues. A colleague once bought a rental without checking neighborhood vacancy rates, only to find the area was oversaturated, impacting his cash flow. Finally, neglecting to plan for unexpected expenses, like repairs or vacancies, can eat into your profits. Having a reserve fund is essential to weather these challenges without risking your investment. To avoid those mistakes, here are the best tools and resources available right now. Investing in real estate with a 7% interest rate can still be worthwhile if you approach it wisely. To make informed decisions, leverage reliable online tools. First, use Credit Karma, https://www.creditkarma.com, to check and improve your credit score, which plays a crucial role in securing favorable loan terms. Next, explore Zillow, https://www.zillow.com, for property searches and market insights, helping you identify areas with growth potential and avoid overpaying. Redfin, https://www.redfin.com, offers detailed property data and valuation estimates, so you can assess whether a property is a good deal. For financial planning, consider BiggerPockets, https://www.biggerpockets.com, a platform that provides resources, podcasts, and community advice on real estate investing strategies. Lastly, use Investopedia, https://www.investopedia.com, to deepen your understanding of mortgage options, interest impacts, and investment calculations, empowering you to make smarter choices. With these tools, you can evaluate your credit, analyze properties, and plan your finances more effectively. Now that you've got the tools, let's talk about the first thing you can do today to get started. Are you wondering if investing in real estate is still worth it with 7% interest rates? The truth is it can be, but the key is taking that first small step today. And that step is simple. Check your credit score. Download a free app like Credit Karma and see where you stand. Knowing your credit score now helps you understand what financing options might be available to you and what improvements you can make. By taking this initial action, you unlock a clearer path forward. It's like opening a door to new opportunities, giving you the confidence to explore properties or plan your finances more effectively. Plus, it creates momentum. Each small step builds your knowledge and moves you closer to your goal of investing or building wealth through real estate. Remember, big successes are often the result of consistent, small actions. So, start today. Check your credit, review your expenses, or even simulate an investment to see what's possible within your current financial picture. These actions set the foundation for your long-term vision, building a portfolio that generates reliable income and appreciates over time, even with higher interest rates. Taking that first step is how every long-term success story begins. Let's look at what happens when you stay consistent. Imagine it's 2035. You started investing in real estate 5 years ago, even with interest rates around 7%. Through consistent effort, reviewing your credit, researching properties, making small, strategic investments, you've built a solid portfolio. Today, you own 3 cash-flowing properties that generate reliable monthly income, and your property values have appreciated steadily over time. Fast forward 10 years, and those investments have grown even more. You might own 5 or 6 properties, each contributing to your financial stability and freedom. The power of compound growth means that your initial small steps, regularly reviewing your finances, staying informed about market trends, have compounded into a substantial asset base. Looking ahead 30 years, with patience and consistency, that portfolio could easily expand to 10 or more properties. These assets could provide you with a passive income stream, helping you retire comfortably or pursue your passions without financial worry. Even with higher interest rates, the key is persistent, measured action, adding to your portfolio one step at a time, reinvesting earnings, and staying committed to your long-term vision. Remember, success in real estate isn't about quick wins. It's about steady growth over time. And now that you see what's possible, here's how we wrap this up and take action. Start today, stay consistent, and watch how your future transforms. Because the best time to invest is always now. Is investing in real estate still worth it with 7% interest rates? The answer is a confident yes, as long as you approach it with strategy and patience. Remember, even with higher borrowing costs, investing in properties can generate passive income, build wealth over time, and offer long-term appreciation. The key is to stay informed, improve your credit, research the market thoroughly, and keep reinvesting your gains. Small, consistent steps can lead to big results, proving that real estate remains a powerful tool for financial growth, even in a higher interest environment. Thanks so much for watching and celebrating your progress on this journey to financial freedom. If you found this helpful, don't forget to like, subscribe, and comment below. What's your first financial goal for this year? And if you want more tips, check out our video on how to build wealth with real estate. Remember, success comes from taking action and staying consistent. Keep moving forward, and I'll see you in the next video.